Hey, everybody. It is almost 2025. Can you believe it? I certainly can't. Saying things like that makes me feel old. It'll be my 25-year high school reunion next year. I can't believe it. But here we are getting into 2025. And if I'm being quite honest, there aren't as, the opportunities for in the stock market don't look as attractive as they did when we did this same video a year ago when we were heading into 2024, and really when we did when we were heading into 2023. Uh, you know,
Well, when the market goes up 27% for a year, like one of the 10 best since the Great Depression, it's it gets harder to find like stocks trading for reasonable valuations.
well, and one of the things that I want to get into, we'll get into this in a second, but is that it's there are two different stock markets right now, right? You have the mega cap tech stocks, which have just gotten straight up, and then you have some companies like real estate and dividend stocks and all that there are still some opportunities around. But we'll get into that in a second. Before we dive in, check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So I'll dive right in. One on my list, and it's a stock I've owned for a long time that, if I'm being quite honest, has kind of been dead money in my portfolio for the past like 5 years. And that's Howard Hughes Corporation. Ticker symbol is like they're Howard Hughes Holdings now, excuse me. Ticker symbol is HHH. They changed it from HHC. No one really knows why, but here we are. So Howard Hughes Holdings, uh, they are a real estate company that they're kind of a unique real estate company. They call themselves a real life version of the Sim City video games. If you have ever played those, their general business model is they'll acquire a giant piece of land, say like 30,000 acres or something like that. They'll gradually turn some of it into buildable lots that they'll sell to home builders. The presence of those homes creates demand for commercial assets like office properties and things like that, which they'll build and collect rental income. Um, the Woodlands in Texas is a Howard Hughes community. So when you say like they've developed master plan communities, this isn't the 200 home communities that you probably live near, that like the one I live in. These are large scale, like almost small cities. I mentioned the Woodlands in Texas, Summerlin in the Las Vegas area, and the property and this value creation cycle can last a while. And as the Woodlands built out to 100,000 people or whatever, the commercial space demand got really big. Um, I know Tyler follows the energy sector. Occidental Petroleum's headquarters are located on Howard Hughes property. That's in the Woodlands, and they're the landlord. It's a very nice office building. I've seen it. So these are just the kind of properties they own. They have a lot of exposure to office, which has been a negative in recent years. Um, but there's a lot of reasons to like them going forward. One, they're a very rate sensitive stock. Um, Now, I can't really spin this favorably. I mentioned this to Tyler before we started recording. Howard Hughes has a lot of debt. This is a $4.3 billion market cap company with almost $5.5 billion worth of debt. Now, they have almost $1 billion of cash on hand, so their net debt is about $4.5 billion. And a lot of that's in the form of mortgages, like property level debt. So if they couldn't pay it, it's not like the corporation owes the money. It's, property level debt that could, it's less risky. Um, Now, the high debt is an overhang on the stock. It's a problem. Um, they're making more than enough money to cover their debt. They have a debt coverage ratio of something like 1.8. They're earning 1.8 times their debt payments, which is high. It's not great, but it's not an alarm. Um, the average interest rate on their debt is right now is about 5.7%, which again, most of this is mortgage type debt. So in a falling rate environment, there will be a lot of opportunities to reduce the cost of their debt. So that's one big reason to like them going into 2025 when the Fed has started to cut rates. I mentioned they have a lot of office properties. Makes up about 1/3 of their current operating income from their operating assets. Um, and the company recently did a conservative valuation estimate, and found that their stock, the sum of their parts is worth about $118 a share. Now, I say conservative, that assumed an office building cap rate of 11.7%. That's pretty terrible. Um, office valuations have definitely contracted in the past few years. More people, like Tyler and I, are both working from home as we record this. More people are joining us. They're all working from home. Not all, but a lot of companies are letting people work from home, at least on a hybrid basis, and it's really hurt office demand. But I think it's kind of overcorrected. I think we're going to see office values start to creep back up. Now that a lot of companies are seeing the value. You're still, I mean, it's 2024. We're like 2 years after the real pandemic shutdowns ended, and you're still seeing companies start to call for more of a return to office. In 2024, we saw a few big tech companies start to say, okay, employees need to work from the office. So I think I see positive tailwinds for the office buildings in Howard Hughes' portfolio, especially since they're mostly high quality. Um, and as just a wild card with this stock, Bill Ackman, the billionaire investor, he currently owns 37% of Howard Hughes Company. It's the biggest investment in his portfolio by percentage of the company that he owns, and he has made it clear that he's trying to what he wants to acquire the other 63% that he doesn't own. Nothing is official yet. Nothing has been finalized. Howard Hughes has said they've formed a committee to evaluate any offer that he might bring them. So that's kind of a wild card. If he does acquire it, it would more than likely be at a pretty decent premium to the share price. So that's kind of an X factor. Don't buy it because of that, but it definitely adds to the investment thesis. I just think there's a lot that can go right for Howard Hughes in a looser regulation, falling rate environment as the office industry continues to stabilize. I think there's a lot of catalysts there, and the stock is just very, very cheap today. So it's more of a deep value play than anything else for me. Tyler, what are you watching in 2025?
All right. So a little unconventional, like you said, because it's kind of hard to find things. So actually, I went south of the border and I went with a Mexican grocery store. It's called BBB Foods. It debuted on the New York Stock Exchange earlier this year. This was a company when I read the IPO perspective, I kind of fell in love. The current CEO is Anthony Hatum. He was it almost kind of reads as like a very similar story to like a Sam Adams or I don't want to say Amazon because that's going way too far, but kind of like these people who were like business consultants or something like that, or worked on sell side equity, doing research. And Hatum had done a lot of research on hard discount grocers. I think if you, I'm trying to think of like in the United States, like Aldi, things like that, where it's really no frills. Things are kind of like stacked in crates on the floor, sort of like grocery, but it's high, priced at very, very low discount rates, and tends to do well with a certain demographic shopping. Basically, he studied this industry for a really long time and like kind of did a white space research and was like, this needs to exist in Mexico because they didn't really have it in this sort of sense. And so about 10, 15 years ago, he went down Mexico and just basically started like talking with people on the street and like how this concept would work in Mexico, and built, I think, one of the most like tailor-made sort of solutions for this particular type of grocery store in Mexico, mostly in more dense neighborhoods because all of its customers are probably walking instead of driving. All of it specifically designs all of the packaging and all of the things on its shelves such that your average customer is probably going to come 2 to 3 times a week. All of these things, there's just like there's an immense amount of thought and care into exactly how they want to build these stores and how and what they want to sell, and that's really showing up. I mean, over the past 10 years of existence, their same store sales have grown at a double-digit rate. Right now, they have about 2,600 stores in country, and as in the IPO perspective, and they reconfirmed it on its most recent conference call transcript, the opportunity that they are seeking is a 20,000 store footprint across all of Mexico. So we're looking at a 10x increase on its current store count, on top of what has been significant growth on same store sales, all of which has translated into revenue growth over the past several years, pre-IPO, in the 25 to 30% range. Now, it's hard. It's a hard discount grocer. Margins are pretty thin. So we're not talking about anything that's going to, do huge margins. I think its EBITDA margin right now is like 4%. The good thing is like, when you have very low margins like this, if you can efficiently operate and maybe wring out a half a percentage point of profitability, that flows a lot to the bottom line. And so just little things like that, where they're able to wring out a couple savings here and there, they'll be able to probably generate significant profitability. They were unprofitable before interest expenses pre-IPO, but after the IPO, they've been able to pay down a significant amount of that debt and have, it's starting to get much, much closer to profitability. And the other thing that I like about it, and I've seen this with other retail, like very, very competent retailers, like I think of like auto parts retailers like AutoZone or O'Reilly. They have what's called a negative cash conversion cycle, where basically they are able to, uh, because it's groceries, basically they are able to, turn over their inventory so fast before they have to pay their suppliers. So basically they have a negative cash conversion, basically, where they get to sit on cash for a while because their customers have paid for their goods before they have to pay their vendors for their invoices and things like that. If you look at very, very well-run, well-operated retailers, especially in the grocery space, you get a lot of these companies doing negative cash conversion. So all of it together, you have a good operator with a very tailor-made experience that seems to work very well, a 10x opportunity in store count over the next several years, and something that's just, it seems to be working well, like I said, with double-digit same-store sales growth. I think with all of those things combined, I really like the way this company is shaping up. I've been watching it for the past couple of quarters, and I know that I can't buy it for the next couple of days because we're talking about it here, but it's certainly one that I'm probably going to be adding to my portfolio before the end of the year.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.